Well, welcome everybody. TBD Podcast, episode 8. Here today with David Clemens, DKC Lending. What's going on, man?
Awesome, man. Thank you for having me.
Of course, man. So how did you get into hard money lending?
That's a loaded question. I love it. Starting in real estate as a realtor, actually.
Yeah.
So, I was a realtor and ran handyman crews and did a lot of renovations and things like that. Eventually got into property management and met a guy who was giving out some private mortgages to friends and family and kind of was introduced to the game right then and there.
Yeah, it's always, anytime I talk to someone who's involved with hard money, it's either like the rich uncle, the friend, like a guy. Is it usually like that? I mean, in your experience, is it someone just with basically extra capital to deliver out?
Yeah, it normally, there's not a lot of institutional grade private capital guys because like you said, they're normally independent guys that are normally wealthy or have family money, or I've met a lot of attorneys that are doing it as well because they're writing the loan documents and typically have access to high net worth individuals. But we try to take a different approach where we try to add a corporate style or institutional style to a truly private side of the business. So I think we took a unique approach when it comes to that. But yeah, I mean, when you're talking about a high net worth doctor or attorney, and you need deal after deal, if they're on vacation that week or they're just out of money because they're not setting up an institutional grade bank per se,
right?
It can be challenging for investors to get consistent capital.
What would be the advantage of someone like a doctor who's not necessarily a real estate professional, but they've got maybe a couple million in cash that they want to lend out? I just can't imagine that. It seems risky, right? It seems like, hey, if I'm a doctor, I don't know if I want to just lend out money without me keeping a super watchful eye on it.
It's true. And that's honestly, those are a lot of our investors, so we've raised capital from private investors here locally at the Tampa Bay area. And I think they choose to invest with us because we are the professionals in the space. We're doing it every day. We've been doing it here for about 7 years in the Bay Area. And we have, like I mentioned, the real estate development and property management company. So I think they're typically looking to align with a small local group, which again, there's not many of. It's kind of a niche space.
Yeah, for sure. But a lot of people love real estate. There's so much buzz about real estate, especially here in Tampa. So I'd imagine if you were that doctor or lawyer, you're not a real estate professional, you kind of have an idea of what's going on in the real estate space. So it seems like an easy way to get involved without owning property, right?
That's right. And I think on the development side, there is a fear of a lot of management when it comes to owning the assets themselves and being a developer. Or
I don't want to fix toilets is like the classic term.
Exactly. They're terrified of that. And so we're trying to, we create a completely passive investment platform for them to be able to park capital, earn 10 to 11% returns on their capital, and be completely hands off. Where
can't beat that.
We're procuring the deal, packaging it up, underwriting it, presenting it in an easy to read format where they can say, yeah, I like the deal, no, I don't. And if they do, they can click a button, electronically sign an agreement, and wire funds the next day.
Amazing.
And then we can kind of talk about the default protocols and things like that down the road. But I mean, if there was a worst case scenario, our development company steps in and remediates the issue. And so it's truly passive from A to Z. And when you're talking about collecting interest only returns or an ACH directly to your bank account once a month, the opportunity starts looking good, especially if the stock market's struggling.
Yeah, absolutely. And I would imagine from your perspective, because you are real estate developer, property manager and an investor yourself, I mean, geez, you almost want that property to go in default in kind of a weird way, because then that's where you can come in with your value add, bring it up to market and sell it. And that investor, that hard money guy, potentially makes a huge immediate return, right?
That there's the potential for that for sure. I mean, I would say that it's not often, especially if you're, underwriting the deal the right way and the borrowers are not taking on too much risk and using enough equity. Mostly borrowers don't want to walk away from 30, 40, 50% equity in deals. They'll figure a way out to remediate the issue or even sell the asset just to recover their loss. Over 900 loans now, we've had 3 defaults. So
that's amazing.
It's not an event that happens all the time, but it's absolutely, there can be upside for the investor. we don't like to see that. We're in the game of repeat borrowers. A lot of our borrowers are coming back for a deal 5, 6, 7, 8 per year, and we want to see them successful so they can go get their next deal.
Yeah.
So we really are we're partners in these real estate deals with our borrowers. We're trying to provide them feedback, guidance on the front end, to make sure that they know what they're getting into, and they're after repair values, their cash flow, making sure that they're thinking about all the different expenses that might pop up, because we truly want them to be successful.
Mm-hmm. You kind of have an interesting story too. You were a professional sports player before you kind of dove into real estate.
Yeah.
Soccer,
man.
Which is such a unique thing. Most people, when you hear professional sport, baseball, whatever it is, but soccer's a unique thing in this country.
It is.
So how did you get into that?
Man, I was a soccer player my whole life, and I'll tell you, if you met me in college when I was 21, what did you want to be? Professional player. What were we going to do after that? I was going to coach. I was going to stay in the soccer world forever. I still am. I was playing soccer last night, so I'm still in the space. But I went to school at Virginia Tech. I was All-American and ACC player there, and then ended up playing professionally for 4 years, primarily in the USL League. The last team I signed for was the Tampa Bay Rowdies, which is how I ended up here in Tampa Bay. And from there, I got my real estate license. My wife and I decided that we liked the Tampa Bay area. Once you come here after living in, I think my next contract was in Oklahoma City. So we're comparing cities. I don't want to hate on the Oklahoma fans here, but
that's a tough transition.
It was.
Now, was that more of your wife? She's like, hey, listen, we're not going to Oklahoma.
I think we were both ready. Another $1,300 a month salary with some free housing with 5 other guys, is a tough sell the older you get.
Right.
It's a young man's game. And by the time you're 24, 25, you're old,
That's true, yeah.
You got the young 18-year-olds coming.
Professional sports world, yeah. Wow, so you got your real estate license, and what did you do initially with your real estate license?
I started leasing properties. So I was just trying to catch a lease fee. I didn't really know much. My dad was in building material sales, so he's flipped homes his whole life, and I've been, watching him from afar, but never been too close because I was always playing soccer growing up. So I knew enough about it that I knew I wanted to. I liked the freedom in real estate, and that was important to me. And so diving into being a realtor, I really was just trying to lease a couple of properties. I remember trying to catch $200-$300 on a lease fee in Harbor Island to see if I can rent out a 1-1 for the week. And so that's really where I started on ground zero in real estate.
I mean, that in real estate, that really is ground zero. It's collecting those lease fees, man. That is the true grind.
It is.
Oftentimes, you're working just as hard, if not harder, on the leasing side than you are just in retail sales, kind of on the back end. So
absolutely, I remember hoping that these clients would turn into buyers one day.
Right, that's always the hope, right?
It is.
Well, it's a lot of work, but maybe they'll buy a house one day, and then I'll sell it, and then I'll build my business. That's always the thought.
It was.
So how did you transition from leases and kind of into the more development management space?
I started a company called Lightning Property Services, where we were managing handymen, and really I was finding jobs for handymen and finding good handymen who didn't want to find jobs, and I was connecting the dots and creating a management fee. Wow. So that gave me a lot of experience on how to.
How did you get into that?
My dad was just kind of in building materials, and honestly, being a realtor, I was leasing a unit, and the guy's like, "Hey, I need to hang my TV, paint the unit. Do you know anybody?" And I was just being asked that all the time. Do you know anybody? And I kept referring people, and then I'm like, if I referred it and then kind of managed the process here, I could potentially make a little bit of a spread.
Yeah.
So that's kind of how it started, and I was using my real estate brokerage to kind of feed leads. And I found out in that space, especially from $150 repair to a $2,000 repair, it's really hard to get a handyman.
Oh yeah.
Especially somebody on time.
We deal with that so often. Whenever you buy a house, even if the home is brand new, there's going to be things that you need to either fix or change for that particular buyer coming in. Yeah. Simple stuff like, hey, the electrical outlet, that needs help. Very, very small things.
Those are the hardest ones to get the repairs done too.
They are, because who wants to come out for a $150 repair, like you said?
Exactly.
So you dove into that, building out some contacts. You had a few different handy guys that you'd refer stuff to.
Then I ended up growing into crews. So then they became crews, and I was taking on larger remodels for other investors. So we were doing fix and flip for other investors. Then I met a guy who had just bought an apartment complex, and he bought a 20 unit in South Tampa, and I was a realtor and had this handyman crew going. So he gave me the opportunity to lease the units, renovate all 20, and manage the property. I saw them execute on that deal, and they was very profitable. I think they made over $1.2 million in 12 months on 20 units. So
what year was this?
2015, 2016.
Yeah.
So it was a really strong deal, and I was like, once you understood the financing part of it, it kind of made sense to me because I had the other pieces.
I've dug into the multifamily space probably for the past like 2.5 years, the bigger multifamily space. I've owned a little portfolio of 11 units.
Yeah.
It always seems like the debt is kind of the biggest puzzle piece in that equation.
Sure.
It seems like finding the capital for deals like that isn't necessarily hard, because if you have a good deal, there's a ton of investors that want to invest in good deals, and good deals are hard to come by.
Yeah.
But that kind of financing portion, where to get the debt, that seems like at least the most challenging part of that pie. So you kind of saw these guys, they made $1.2 million. You're like, holy shit, that's amazing.
Yeah.
And then kind of, where'd you go from there?
So we kind of partnered up, and then we did about six more multifamilies in like 5 years, about 100 doors a year. And at the same time, we started growing the private lending company. So we grew the private lending company to around the $15 million mark with family capital and his family capital. And while at the same time we were buying and selling multifamilies, I'd say it was an easier time to buy from 2017 to 2020. It started like 2021, 22. It got really difficult. I know, a lot of people on this show will know. There were fewer deals out there. It was harder to make the deals work. There was a lot of competition. Stock markets were struggling. There was a lot of cash in the market. And like you said, everybody wanted a multifamily.
Right.
So it became, the hot girlfriend next door that everybody wanted.
Right, exactly. And now it's almost impossible, just because the debt market's really high. Sellers believe their property is worth X amount, which probably is a little bit up in the sky.
A little gap there.
I mean, I think you mentioned to me when we met a few weeks ago, you said that you hadn't bought anything the last like year.
Yeah, in
that
2022.
market has kind of dried up. I mean, I hear a lot of investors say like, "Oh, I haven't bought anything in 22." So
yeah, we were flipping a lot of homes and adding to our single family and mobile home portfolio, because we were under contract on 5 deals in 2022 and spent money on due diligence and went all the way through and tried to make the numbers work. So not for a lack of effort, we were out there in the market. Just the deals, the numbers didn't make sense. So
mostly because of the debt market.
Mostly because of the debt, and I think also the buyer-seller expectation gap. There was, the market was coming down, especially from July to December, and as interest rates crept up, I think sellers weren't. The cash flow is still strong on rental properties too. The rental rates have stayed pretty consistent in the Bay Area.
What's the motivation to sell as a seller in a market like that when, hey, I'm putting money in my pocket every month, and this guy wants to come in and pay X? I'll just wait. I'll just not sell it this cycle.
I think there's like two different groups of multifamily owners right now. I think you got guys like that, exactly to your point. Especially if they're sitting on 2-3% debt that they procured over the last 5 years. But some of my multifamily broker friends are saying that in the last 2 years, over 80-90% of the purchases happened with hard money. So with 1-2 year bridge loans.
Wow.
And I know over the last year or two, there was a lot of, money in the market and not necessarily savvy investors that were making purchases over asking price and not sure of those valuations. And then when the market's dropping, where do those assets sit on 1-2 year balloons? And can they make the new DSCR rates work? I think there's going to be some questions asked over the next, 12 to 14 months. Yeah. So maybe there's some new opportunity coming soon.
I think so. It seems like, even on the, on my side, like the residential people buying and selling homes, it seems like a lot of the buyers right now are sitting on the sidelines saying, I'm going to wait. I'm not really going to buy. Just talked to a guy yesterday that was like, this overheated market. And he's kind of right in a way. I think in the same way as multifamilies was overheated last year, maybe people are getting realistic now. On the residential side, it's the same thing. You've got a lot of people that have chosen to rent and not buy. Kind of my thought though is, as that market levels off, maybe the debt market does come down, and buyers on both the multifamily and residential side are a little bit more comfortable with making a buying decision. Yeah. How many people are on the sidelines that are going to come back into the market and kind of reignite that frenzy? I know a ton of people on that residential side waiting and waiting and waiting. And if everyone waits and the market's good and then everyone tries to buy a house, you're kind of just back where we were, a year and a half, 2 years ago.
Yeah, I think there's a lot of that, especially on the investor side. Guys sitting with a lot of cash right now,
Right.
ready to strike. That goes kind of into timing the market. And, my team, we try to not time the market. We try to have no opinion on what's going on. And we're heavy on data review right now. So we're just reading a lot of data and trying to stay on top of it. So, we say we don't need to be the first one, but we're certainly not going to be the last. We're just going to continue to try to keep buying flips, keep trying to buy multifamilies, keep running the performas. If the performas say that we can flip it, then we'll flip it. If it says to hold, then we'll hold. And, we're just going to, not for lack of effort, we're just going to keep kind of doing our thing and not getting too worried about what the news is saying.
Build up your war chest to take advantage of some future opportunities. I saw a deal. It was a 4-unit down in South Tampa, right north of Inter Bay. Amazing little deal. You could tell it was like owned by grandma, grandpa. They probably owned it a long, long time. I think they actually owned it since the 1980s.
Okay.
And, beautiful condition, no deferred maintenance, great list price. I think they were asking like $760 for a 4-unit. You could totally renovate it and make it happen. Boop. Called the broker, pending like in 24 hours. So the market, there are a lot of people, like you said, on the sidelines with cash that are ready to pull the trigger.
Yeah.
Because I think as an investor and developer, if you're not investing or buying land to develop property, you're out of the game. No one wants to be out of the game. So there's people on the sidelines ready to strike. I found that out the hard way because I'm thinking, okay, well, it's a good market. I'm super bullish on Tampa Bay. Like this entire area, including Sarasota, this whole Gulf Coast, I think is going to grow the next few decades. In my head, I'm like, I don't care if we're on a downward turn right now. I'll still buy if it's a great property. Clearly, there's other people thinking the same thing.
Yeah, and I think you're making a good point. I think it's what's your goal,
right?
And I think you're a young guy like myself. I think we have longer term outlooks right now, and if you're not looking for a short-term investment and it's a long play, then I don't think you care about what's going on right now as far as interest rates. And I totally agree with you. I'm like, if you're going to buy a property on the water or in South Tampa, excuse me, or in Davis Island, I mean, what are we talking about? A value dip over a 1 to 3 year period. If you're going to hold that thing for 10, 20 years, it's all about the debt that you're putting on it, the cash flow situation. And then, we're in it for the long run.
I think so. I think premium properties will always demand a premium price, especially including location. I started in real estate. Next year will be 10 years. So this is my 9th year. So I kind of saw, where were we? 2014, I got licensed. So you kind of remember back in 14, 15, the opportunity was unbelievable. Yeah. You could get in with super low debt. There was a ton of stuff on the market. So a lot of buyers had choices and you could make things work, immediately cash flow. I think now we're in a completely different world, but I've kind of seen that cycle of like a dead time, the rocket ship that was, we were growing pre-pandemic pretty heavily, but I think the pandemic kind of put gasoline on the fire. So we've seen that and now we're leveling off, but the properties that don't sell and the properties that sit are the ones that unsavvy investors make investments on in like bad locations, negative leverage. I think those type of moves will always be bad moves. They're only not bad moves in a crazy market like last year.
Yeah.
Like last year, this time last year, I think interest rates kind of dipped late spring. Mm-hmm. This time last year, the market was in a frenzy. Exactly. You pretty much, if you secured a property, maybe did a little value add and put it back on the market, you're going to do well no matter what.
It was hard to fail.
You can fail easily in this market though. There's properties that have been sitting for a long time and you can kind of tell, wow, that was a cheap flip.
Yeah.
Oh, they're bagging it. They must have bad debt. Like there's those opportunities are I think out there.
100%. I think, and coming from the lending side, we're looking a lot at applications, right? And I kind of use applications as a good gauge of what borrowers or investors are doing in the market right now. And right now, we were doing about 50-60% fix and flip loans every single month for about the last 3 years. And now over the last 6 months, we've seen 90+% be refinances. And so
what a shift.
Yeah, so there's such a high level of uncertainty on the exit especially if you're flipping it. What's it going to be worth in 3-6 months? Who knows, And if you don't have options, that's when you can get into those types of jams that you're talking about. So one thing that we're encouraging our borrowers right now is to look at just having options. And so every time that we're going to flip a home right now and we're pulling the trigger, we're still buying flips. I have 2 on the market right now, but on those flips, we're prepared to hold them.
Right.
And so if you're not prepared to hold them and you have all your eggs in that basket, and you need to be able to make a quick decision and take a loss and move on, or convert that to a long-term hold.
Yeah, we kind of ran into that scenario a little less than a year ago. I think it was like last April. We went under contract on a lot. It actually had a little house on it in Sarasota. So phenomenal location, like A+ location. I think it was like $675,000. You could have built a home that you probably could have sold for maybe 2.4, 2.2. Like the spread was good. You were going to make conservatively like 400 or 500 grand. It was all good. And we went under contract on the deal. And as we were going through due diligence, we just thought, you know what, this market is a frenzy right now. We don't have a crystal ball. We don't know what's going to happen in 2 years when the product's completed. You know what? It's a little bit safer of a bet. Why don't we get something that is a value add? So buy a property, 1980s block construction, a solid build, under replacement value.
Yeah.
Fix it up. You can fix up a property in a couple months and kind of put it on the market in relatively the same market you're in.
Yeah.
New construction, you don't really know what's going to happen in a few years.
Especially on those larger luxury products where you're talking the build time 18 months to 2 years.
Exactly.
Yeah. But I mean, and that's where there's a cash flow situation. Those loans are harder to procure right now. I always try to talk from a finance side. New construction loans are tough, and they're tougher now than they were a year ago.
I can't imagine any bank really wanting to even loan on that.
Yeah, and even a lot of private guys are steering away from it. I think one of the aspects is cash flow, obviously. When you're 60, 50% through a new construction project, you have no ability to get cash flow. Versus you're
bleeding.
You're bleeding. And honestly, if you don't have some sort of reserves, which a lot of the institutional guys are really looking for heavy reserves, heavy equity to be able to take those types of projects on, because you get jammed up on a truss order for 4 months. If it's a $1.2 million loan and taking at 12%, that's a real fire under your ass.
We work with a developer builder in Sarasota, and we had a lot of customers kind of complaining to us like, hey, this guy's changing the prices. It's like, well, by the time you guys have contracted on this property at a certain price, he's now had to book these materials. The materials have gone up 30, 40, 50%.
Yeah.
So it's kind of like, hey, sorry, it is what it is. And granted, all those people still did great. We had a guy buy the model home we were selling. I think he paid like 2.1. That home was listed and we had a high level of interest at like 3.5 million. So he, just by buying a new construction home because of the available inventory in the market, the guy made $1 million.
Sure.
So even though he had to pay a couple $100,000 extra in materials, on the back end, he was fine. And all those people were fine.
Yeah. There was still a lack of the right new supply.
Right.
And like even right now, we're at an increase of almost 100% of supply on the market today than what we had a year ago. But when you're talking about new luxury supply, I think we're still at a shortage.
I think so too. Finished supply. Yeah, because I think if you look at the market, there's a ton of property available, but it's dirt with a rendering.
Right.
And that's kind of a tricky situation. When you have a lot of new inventory that's just conceptual, it's not. I don't really think that's going to help the market at all. I think if right now you could snap your finger and have a new construction luxury home, boom, that thing would sell in a second, because there are a lot of those buyers still out there, but they want move-in ready.
100%. And I think even I'm curious to hear your take on some of the high luxury condo market a little bit, because I know that's I know you own a condo downtown Tampa as well.
Yeah.
I think there's still some merit behind the $1.5 to $2 million price point and up is a little bit more resilient. And then I think that 500,000 to 1.2 range is suffering more. And then I think affordable housing is, when you're talking about $250,000 and less, there's still a lot of buyers active in the market. So
yeah,
when we're talking about price point, that's something our team kind of looks at. And I'm hearing a lot of other borrowers of ours say that I'm going to kind of stay away from these $400,000 to $1 million type of assets right now, just because of how they're moving.
Yeah. I mean, anyone that was in that kind of lower first-time home buyer price range. It's funny, first-time home buyer used to be like $250,000, $300,000. You can't buy anything in South Tampa for under $500,000. It's crazy. Anything decent. But a lot of those people are sitting out. Interest rates have made it basically unaffordable. Like I said earlier, a lot of people are just going to rent moving forward. That luxury market, though, a lot of those people are not necessarily affected by the high interest rates. One, because they pay cash. Now, kind of conversely, as the interest rates have gone up, especially since last April, May, when interest rates skyrocketed, we had that inflation scare and that whole thing. That took a huge toll on the stock market, investment portfolios. A lot of the people that have big investment portfolios, when they take a hit, you start talking about, you're looking at your account and you've lost $500,000 that day. You're kind of less inclined to make a luxury home purchase.
Yeah.
So we got a lot of that last year, and moving into summer, a lot of those people were like, hey, we're not going to contract on this house, or we're going to get out of this contract. We want to wait and see what happens.
Sure.
So you do see that. Our saving grace here in Florida, I think, is kind of always been two things. One, and we've added a third since COVID. So in Florida, there's been two reasons why we've always had a good market here, and we've stayed relatively insulated from the rest of the country. One is because of the retiree population moving here. Yeah. Oftentimes, they're more high net worth individuals with cash. They're going to move here no matter what. They want to be in the sunshine. They don't want to be up in New England or the Midwest anymore. They're coming no matter what.
100%.
So kind of having that base of buyer demand always moving here insulates us from other things outside, of that space, right? Like, no one's really retiring up north. They're all coming down here. So if anything were to happen nationally, like an inflation scare, at least we have more people moving down here than leaving.
Sure.
So number one is that. Number two, I think, is just the influx of people moving here because it's a great place to live.
And the tax savings, and especially when you're talking about out of state.
All of that stuff. Like, Florida has 0% state income tax. The sun's shining. It's beautiful. So that's always kind of been a second draw. We've had that base of people moving here, a lot younger people moving here than traditionally. Usually this coast of Florida also was Midwestern people. We're getting a lot more people from the West Coast and people from New York, New England moving down here. And then now since COVID, there's this weird kind of, you could call it political, government, whatever, but I think on one side of it, a lot of the states that people are moving from are literal like refugees. I mean, we've gotten calls from people from some of the nicest neighborhoods in Miami that have ended up buying property with us, and spending $7 million for a beach house on Casey Key, which is down in South Sarasota, kind of county area. Those
it's
people.
It's a bargain for what they're used to.
It's a bargain, man. Like, this guy came from Beverly Hills. I got to get out of here. I don't feel safe. I don't feel safe with my wife, walking with the baby in the neighborhood. Like, we're out. We'd never seen that before. I mean, we have never had those calls before.
Beverly Hills.
And Beverly Hills, man, who the hell would want to leave Beverly Hills? That place is incredible.
I mean, I gotta, what do you think the average purchase price is in Beverly Hills?
Oh my gosh, a lot more than $7 million.
I was gonna say, you could get the nicest house on Clearwater Beach and be half the price. Half the taxes.
This house in particular was an incredible, super sexy, slick, modern home on the beach. You know how much a beachfront home would cost in Malibu?
Oh my goodness.
Los Angeles Beach. I mean, it would be like $20-30 million. So I think there's that driving force here, which is going to insulate us from a larger market dip. And I think you've already seen it. You've seen markets around the country dip 10, 15, 20%. It ain't happening here.
Yeah. And I think it depends on the area too, a little bit, because we have seen some dips in values. Like if you're talking about Pasco, Polk, like those
Yeah, for sure.
And even in some areas of Hillsborough County, especially if you're up by Sulphur Springs, and on the price per square foot, that what they were selling for last summer, versus even today, has come down almost 10%. But then when you're talking about South Tampa, Pinellas County, it hasn't moved.
Yeah, like I said, those premium locations will always be insulated for that reason. It's just a place where people want to live. And a lot of people coming are going to move here no matter what. Yeah. They're retiring. They're refugees from another state. They've got money in their pocket. Florida's still on sale.
Yeah. It's funny. I love hearing your perspective on the luxury market. One of our, we focus primarily in the affordable housing areas. And, right now we're really heavy in Newport Richey and Holiday, Hudson areas, and also in Polk and Plant City. And so we love that market. We have a lot of FHA buyers who are buying their first home, and so hearing the luxury side is a different perspective that we're not always seeing on a day-to-day basis.
Well, it's an important perspective because I think a lot of those, like air quote, like luxury buyers, anything over maybe $1 million, I guess you could say it is, those people in a lot of ways completely can save the economy. They come here and they're paying high property taxes. That's more money for our government. Sales tax, they're going out to eat, they're spending money, they're buying, they're going to retail centers. They have a lot, a high net worth family has of course a lot more of an economic impact than some other maybe workforce housing family moving.
I think also they're not as concerned about interest rates, to be honest with you. Like you said, they might be buying in cash completely, or they're looking at, and as most people should, interest rates are a short-term problem. And you're buying the house, you're dating the interest rate, as I hear a lot of realtors say.
That's kind of what we're telling everyone now is like, look, don't so much focus on the market. And you kind of touched on this a little bit with lending where, hey, look, focus on the property. Like if you love the house, just buy the house. I mean, interest rates are a little bit higher than they used to be. We don't forecast them going back down to what they were, at least anytime soon. So it's like, look, if you love that house, buy the house. Now you can kind of put your feet up a little bit and wait for that opportunity. I wouldn't say you need to be in a rush, which is good news for a buyer.
And when you're an investor specifically, it's, typically you're sitting on cash. That's why you want to invest, right? And your cash is being eaten up by inflation. So you do have a little bit of motivation to get out there and make the purchase, right? Or add to your portfolio or flip a home or create a return or whatever it might be. So I think, like not having that opinion on it and just, looking at the facts and being unemotional about it and just operating within it, it's being able to shift and make adjustments based on what the market's telling you.
Yeah.
So for instance, we were really almost trying to double down on flipping homes, and like, why, we were trying to flip about 6 to 10 homes at a time, somewhere in that range, using about $2 million perhaps so it's not, again, in that affordable house, you're buying for 120 to 200 and you're putting 40, 50 grand in these things and trying to sell for low 200s, 300s. So can you get, like, we were trying to really get 8, 10 of these things going and almost getting frustrated to a point, like we can't find more deals. And I think we had an enlightenment moment where we're like, if there's not more deals there, then let's just look for more holds or wholesales or loans, So we just kind of shifted our priorities because there's plenty of activity in the market still. So we also own a wholesale company, Elite Cash Buyers. So we kind of took our focus from the fix and flips to the acquisitions company. So if I can't, if we're sourcing all of these deals and contracts and we can't take them on ourselves because the flip's not working, well, then let's just wholesale them to other investors who have different appetites.
Interesting. And it kind of brings up that point you said earlier about having multiple exits where it's like, hey, look, we bought this property for 150, we put 50 in it. It's worth, let's just say we have a profit equity of like 75 grand. You guys are in a market where if you're in the right spot and you've done a good enough job renovating it, you could probably lease the property out and hold it and be okay, or wholesale it or sell it. So it's like I think right now for investors, just from people I've talked to, everyone's like multiple exits, because I think in this type of market, if you make the wrong move, you can get hurt.
And knowing where your boundaries are, what are you looking for exactly? Because if you're used to investing in mortgages at 11 to 12% and, you're hedged at 70, 60% loan to value, and that's passive cash flow at 10, 11%, then you're going to want to make more than that on a fix and flip, so, or on a hold, so it's like, what are your cash alternative uses really? And a lot of people don't know exactly what they want. And so I think I try to get them to focus on, I hear people say all the time, I want to flip this home and I want to make 30 grand. 30 grand, what does that mean? If it's $100,000 home, 30 grand, it's pretty good. If it's $1 million home and you made 30 grand, that's terrible.
Yeah.
Do you know what ROI you're looking for? And then if you're leveraging your cash, what is the cash on cash return that you're looking for?
Right.
And I think a lot of people don't dial in those numbers, and those numbers set you free, honestly, because then it becomes black and white decision making. Because if I'm hitting 11% on my loans, then I need to hit a minimum of 12% cash on cash to hold an investment property.
Because you guys are in the hard money, private money space, and some of those rates can approach 13, 15.
Yeah, I mean, the standard for private lending is like 12% and 2 to 4 points. And there's a lot of guys that charge 6 points out there.
You got to find a sweet deal to cash flow at that price, or have the extra capital to kind of put into the deal and have a smaller loan amount.
Well, those are bridge loans technically. So they're 1 to 2 year loans. Mm-hmm. So, you know, it's a tool in your tool belt, as we were talking about earlier, because I use hard money to buy it, fix it up. And then the minute that asset's stabilized, I'm looking to refinance and procure long-term debt. Mm-hmm. So I'm not looking to stay on my hard money loans for more than 6 months to a year.
That's kind of a risk though, right? I mean, you know, what if that debt market dries up? You've seen obviously the news about Silicon Valley Bank, and then there's other banks that have fallen. Sure. It seems like the appetite for these larger institutional banks to kind of do that Burr method for people, where someone comes to them with like a value add, and the bank has to pay off the hard money lender and maybe also put some capital in the investor's pocket. It seems like that's definitely dried up a little bit in the last few years.
Yeah, I'm not seeing a lot of investors be getting cash in their pocket after the refi too. Right. Even like right now, our multifamily term sheets, you know, they're changing every month. I just got a term sheet from a local bank here at 6.75%, and I had it at 6.5 not 30 days ago.
6.75. How do you even buy something? Now that would be that's
for a multifamily commercial loan and a 20-year amortization schedule.
Jesus, how do you make anything make sense at 6 3/4% interest?
There's a lot of value. So honestly, this deal, we were looking at a 9-unit on Hudson. It's actually on the water, and it was a repossession from another lender. And so on that deal, we could make it work at a 6.75. Again, I don't care what the rate is as long as my pro forma is speaking to me. And so on a deal like that, value add becomes really important to create that equity. The banks right now also want to see long-term equity in these things. So even I told you a story about the 20 unit that we bought.
I wanted to get into that specifically. Can you kind of walk us through that? I mean, not finish your story,
sure.
But yeah.
Yeah, but I mean, they want to, even if you have a big appraisal and you've created tons of value through the renovations and you have a big appraisal, they're still concerned about what your cash basis is, and they don't want to cash you out of that deal. Typically, they want to see you leave 15% cash in today's market. And so, you know, that's a challenge for investors because 15%, you know, can be a big number the larger the deal gets, and you got to be okay with leaving that cash.
A lot of people are used to getting that out too, right?
They're getting used to getting it out, but there's other ways that we were talking about, you know, to move on to the next deal. If you're a newer investor and you don't have substantial amount of capital, but you want to get into these deals, there's a lot of other techniques you can use and create joint venture agreements and bring in partners and basically make trades for equity. And if you can do that and park somebody else's cash into the deal who may have more than you, you just need to be looking at what cash needs to be left in the deal and what the cash on cash return is for them.
Right. That's kind of the silver lining to this whole, I think the state of the market right now is there's a lot of investors that are still willing to do good deals. It's not like everyone has thrown their hands up and is just, I'm not buying anything. I'm not selling anything. We're not doing anything. People still have their chips on the table. So I think if you have a good deal, oh shit, we can't refinance, we can't do this, we can't do that. It seems like there's other ways to approach investors to get them involved.
Well, I think now more than ever, it's a great opportunity for that because of alternative uses. I talk about that a lot, is about the alternative uses. If you're a high net worth individual right now, you have cash and you have to park it somewhere. You're losing money every day from inflation, so you need an investment. So if you put yourself in their shoes, they're looking at stock market investments, right? What are the returns that they're looking for there? Now, then you look at real estate development deals is a place where a lot of high net worth investors park cash, longer 1, 2, 3 year projects, large commercial land development type deals. Well, in uncertain markets, land development, those types of projects are looked at as speculative and uncertain, right? So they're looking for collateral, less risk, and a high return. So as you keep going through alternative uses, we know we've been able to raise a lot of money on mortgages because you can now fund a mortgage for a 10, 11% return, like I said, and be 70 cents on the dollar in terms of tangible collateral. So those are really, that's really looks good in today's market. And then on multifamilies, if you can park capital on a multifamily and again, see a 10 to 12% cash on cash return with long-term debt, depreciation, appreciation, it's not a hard sell if you can make those numbers work.
No, especially because there's so much volatility in almost any other investment space.
Yeah.
I mean, where are you going to get that kind of return anywhere else?
And security. It's like the security and return combo,
It really is, yeah. And, as long as you're in a good market, which is very easy to prove, especially here in Tampa Bay.
Especially here.
It's an easy sell, man.
Yeah, and I think rents have, we just did a number of renewals at our apartment complex, almost like 20% from even last year to this year. And I know rents are stabilizing. I'm not expecting another 20, 30% raise next year. But it's still higher than what we really anticipated when we looked at the performance 2 years ago.
Yeah, this new market's just a benchmark. I don't necessarily think it's a bubble. I don't think it was one of those things that kind of go up and then come down and stabilize. I think it's just simply a lot of these people have moved here. They've kind of come and set the price. They've set the rent. They've set demand, and it's just a new benchmark. It's kind of like where we're at. Do you see rent going down?
No, I don't.
Yeah.
And I think interest rates, uncertainty, they're kind of all this extra cash in the market working its way through. I think a lot of that is settling. And I think that's what it's going to take to settle in. I mean, nobody has a crystal ball, but I think there's probably more of a stabilization period. Mm-hmm. And then, like you said, getting used to the new norm. And then can you make the new interest rates work with the new rental rates, with the new debt service coverage ratios? And then that's kind of where the magic is it's all in those pro formas.
I think this is the new market for the next few years.
I think so.
One, because there's a little bit of financial, instability right now with kind of the bank collapse, and there's some fishy shit going on. And I think that will always make investors and end users a little bit more apprehensive about making a decision. And then also too, people need to keep in mind next year is 2024. That's an election year. Whenever you have an election year, we see on the residential side, a lot of people want to see what happens. Like you'll see people not buy a house May, June, July, August till November. Okay, yeah. Who got elected? Okay, let's just see the victory speech. What's going on? All right, cool. We're back in.
For sure.
A lot of people just get a little bit hairy about that. So I would say the market we're in now is the new market. I mean, my prediction would be this is the new market until, let's just say, like a year and a half goes by. It's kind of this new kind of stable. There's good deals. There's bad deals. A buyer can go in and usually negotiate well with the seller. I don't think we're going to go back to a point where you're going to have to be paying over asking for property.
Yeah.
And I also don't necessarily think that sellers are going to have to drive their asking prices into the ground. I think we're just in this kind of stable space, and that's where we're going to be for the next 18 months.
And it'll be interesting to see what opportunity presents itself on the investment side, specifically for me on the multifamily, and like I said, where are these 1 to 2 year bridge loans that were pawed over the last, 24 months, where are they going to end up? And, I think there will be some people that have some economic stress.
For sure.
To work their way. We bought 10 homes in July and sold them all, in between November and December. And, they weren't home runs. Let me tell you that. We were like making 2 to 5%, and that was good. And those were small deals in affordable housing areas. There's other guys that took on, other groups that took on larger projects that, they haven't even failed yet because they haven't been in the project long enough to figure out if it's going to work.
Yeah, last July, you'd probably be biting your nails a little bit because you're in different territory.
Yeah.
And you contracted to buy those maybe May, June.
Honestly, we contracted them all in July and closed because when we're in the wholesale space, we're getting a deal and closing in 3 days.
Damn.
So we're used to like anything we see. If we see it, it's like if my deposit's not out in the next hour, I've lost it.
Now that was after the interest rates skyrocketed and all the inflation news came out.
Yeah, I think June, July was the peak, according to all the data I'm looking at. And then, if you compare that to January, February, in some markets, it was 10, 15%. And if we were trying to make 20%, 25% per deal, and we ended up making 5% out of their transactional fees, it's about right,
Wow. So you kind of spoke a little bit about that 20 unit. A lot of new investors want to get in the game and they don't have a large amount of capital. Of course, if you've got a ton of money, millions and millions of dollars, you're super flexible and you're kind of like limber to be able to go out and buy deals, especially cash. I'd imagine cash deals right now. Boom. If you can pay cash for a 20 unit, you can get a decent return.
Yeah.
Now for you got in this deal without your own capital, correct?
Yep.
So kind of walk us through that. I think that's interesting for first-time investors.
Yeah, and I did end up leaving cash in this deal, but it was just in exchange for more equity. And if you didn't have the cash, there's plenty of, you would just take a smaller equity piece. So starting at the beginning of this, it was a 20-unit apartment complex in Tampa, Florida, and it was a wholesale deal as well. There was, I think we were like the third buyer to come to the table on it, and we had to close in 10 days. Put $250,000 non-refundable down. We used one of our hedge funds to actually close the deal, which we spoke about the difference between institutional hard money and private hard money. So we went the institutional route to get a higher loan to value. They had to look at some of our credit financials, our personal guarantees a little bit closer. It wasn't just a collateral-backed loan. So we were able to get 85% purchase price and 100% construction financing.
That's pretty damn good.
But it was on a 6-month bridge. So it was a fast project.
That's a nail biter. Holy shit.
Yeah. And the extension fees on that was hefty per month, more than we'd want to pay. And it was to the day. So we actually got through the renovations on that. We did about 14 or 15 of the interiors and 100% of the exterior in 6 months. And we signed leases on about 15 of the 20 units. So we proved the concept. And these banks do want to see you get 60 to 80% through the project. Now, you can get some better banking terms if you're still in the project and versus being 100% finished and going for the refinance. We can talk about that a little bit. But we took it to the bank because we had to at the 6-month mark, and that we were about 75% through the project. We procured the refinance. We were able to cash out. But again, even though we had a huge appraisal on the thing and created a lot of equity, the bank didn't want to see us walk away with no skin in the game. So they made us leave 15% in that deal. And so that's when, there was a capital call for, X percentage of equity. So talking about the finance side on that, it was like a $2.15 million purchase. And so the 15% down, we needed about $615,000.
Since you own the deal, could we pull it up?
Sure.
Just so I can take a look. Yeah. You want to give Tyler the address?
Yeah, let's pull up. It's 84.
Probably Google 20. Maps, I would say, right? I mean, there's not.
I think I have.
Unless you have an OM.
I think I have a leasing. I think I have a leased unit on there. I keep up. It's 8420.
So maybe
North Lois Ave.
Okay.
There's 5 buildings there, so I'm not sure which one in my listing is, but
Lois.
It's on Lois and Waters.
Up north. Okay.
Up north a little bit. 8420 North Lois Ave.
Right there. Very cool.
So we took this on that $615 cash. We brought in an investor, and they put the cash down for us. So we were able to procure the first loan with no money up.
Bunch of duplexes here?
Quadplexes. So
those are all quads?
Yeah, they've all got new roofs. So this is an old video with the 1, 2, 3, 4, and we got the land in the back with the big pond.
Interesting.
There you go. Oh, there they go. They are painted.
Wow, those are phenomenal. Like. Those are beautiful. Great work. So this is obviously after you've gone in.
This is after. We got to redo the parking lot, and this was right after we tented all the buildings for termites, and it killed all my sweet viburnums in the front. So you can see they're all dead. We've had to since replace. But
they're out of style anyway, to be honest with you.
Yeah. I love those viburnums because they're just like, they'll sit there forever unless you termite tent them and kill them.
Right. Yeah. you never want to do that.
Watch out for that.
Any plant that can survive that's an investor's plant right there.
Yeah. So they got 2 units top, 2 units bottom, 2 staircases.
Beautiful.
They're 2 ones, about 850 square feet.
Phenomenal.
So they're great rentals.
It's what people want.
They were going for $1,350, and now they're going for $1,750.
Amazing.
On the 1-year renewal.
So you paid 2.1.
2.1. We had to put the $615 down. So our investor we brought in for a percentage of equity. Mm-hmm. Now you can give 35 to 50% equity or whatever is right for that deal, whatever they're willing to do. Especially if I'm starting, I would have been willing to give away even more equity to make the deal work.
Do you kind of approach an investor with a good deal like this, and because the deal is phenomenal and you sound like you believe in it a lot, obviously, right? You can kind of see the future potential. Do you go to that investor with a kind of a, hey, whatever you want attitude? Or do you have a specific like, hey, here's the deal, here's the numbers, like here's what we're offering you?
Yeah. So, we go with a specific offering now. It wasn't always like that.
Yeah.
So, on this deal, I needed $250,000 non-refundable. And, there was no guarantee.
How do you find the guy to do that? That's a ballsy man.
He is.
Or someone with a lot of extra cash.
He is, and he's a great guy and a great partner. And he's been with us for a long time. So he had seen us perform, my partner and I, Caleb, he's seen us perform on other deals. So he had confidence in us. And honestly, he put a lot of trust in us. He didn't go to the property or, you know, and honestly, we didn't have inspections or appraisals. So we were really trying to figure out what the after repair value would be on a cap rate. And there was a lot of uncertainty around the project, but we were confident in the area and the asset type. So
what month and year was this when you purchased the property?
it was in June 2020.
Got it. Now that
2021, sorry, June 21.
21, which was a good market. Do you think the deal, given the same price, you know, everything, could have been done June 2022 when the debt market kind of dried up?
No.
Yeah.
I got
right place, right time.
Yeah, and honestly, we closed that. Thank God. Honestly, in hindsight, thank God it was a 6-month balloon because it forced us to refinance in December, which was before the interest rates started climbing.
Holy shit!
So it was kind of, you know,
holy shit.
We got pretty lucky when it comes.
What's your rate?
We got 2.5% for 5 years, and then 0.5 point over prime after that. But we'll be renegotiating at year 4.
What a screamer!
Yeah,
unbelievable. Congratulations. That's a great deal.
Thank you. We got 2 years of interest only on the thing too, which was even, you know.
So you're flowing, you're cash flowing.
So it was a good deal for us. But so we brought that partner in for that equity exchange. And then at the refinance, there was a capital call. So really actually we had to leave about $600,000 in the deal on the long-term refinance. And we also needed $600,000 for the bridge loan. So he put up the 600, got it back at the refinance, and then we all came in together with new capital as equal partners.
Beautiful.
And so we were able to secure our equity position, number one, by finding the deal, number two, by managing and improving the asset, and number three, we actually put cash in.
Mm-hmm.
But if you didn't you could do any of these 3 things and exchange equity. I mean, if you source a deal, you could bring it to us or many other groups. I mean, we do give out equity to guys who will help find deals. Mm-hmm. I think that's a little unique. Not everybody does that. Mm-hmm. But we would.
It's certainly a good incentive.
Sure.
Especially for a broker, for a wholesale guy, or just someone who's obsessed with real estate, wants to get involved. A young man like Tyler, I could see Tyler scouring, you know, what is it? Remine, LoopNet, Reonomy, I mean.
Yeah, exactly.
Yeah.
That's how you get started. I mean, honestly, that's the best way to get in is help find a deal. And then if you can bring it to a group like ourselves or anybody else that can operate it and allow you to be a part of that project. I mean, it's the same story as me in 2015 when I was just a part of a project and got to see how it went.
Yeah.
And then once you kind of understand the metrics and how it's moving, you know, now you can go ahead and take that and create one for yourself.
So you paid $2,150. And then it appraised for what?
$4 million, like $395, and we were about like 2.8, 2.9 into the thing.
Now, currently, if you were to sell this, put it on the market, what are you kind of feeling out for a cap rate? I mean, what do you think it's worth?
It's a good question, honestly.
It's a tough one, kind of to pinpoint. Yeah.
I'm hearing right now, like we were running a lot of, like I'm hearing 6.5 cap right now up in, especially that 9 unit that we were running on the Hudson Performa. I'm hearing from these multifamily brokers 6.5 to 7 cap rate right now. And we were just running it even more conservative to see if it would work. But we're not so concerned in, on this one, I'm never planning on selling, honestly. So,
well, I mean, I'm not in the commercial space. I'm not in the multifamily space. So I don't want to like reach outside of that and you know, speak like I am and I'm an expert, but I can kind of tell you, man, inventory is extremely low. And, you know, I talked about that 4 unit earlier, and I know that's a completely different investor, but
sure.
The reality is if you put something like this on the market that is turnkey, essentially all redone, beautiful, at maybe a 6.5, like you said, I can see it going pending, man. I mean, I can see I can see it getting locked up because, you know, I mentioned earlier about, hey, there's a lot of wealthy people moving here that aren't affected by those interest rates. Well, those wealthy people also are selling businesses up north and on the West Coast. And hey, I got a bunch of capital. I need to park it.
Sure.
What's available? Nothing. Well, shit. This thing pops up. Great location. It's all redone. It's turnkey. You've already raised the rents. It's really cool. I love the setup. It's got a lot of real property on it. I could see it going for a great price.
Yeah.
I think it's still a good market to sell stuff like this.
I totally agree. And it's more just a personal preference on like portfolio standpoint. Like, you know, I'm just 30 years old. I'm just looking to add doors right now. Number one, I need doors to grow the property management company, which is, you know, it's hard to grow a property management company with no properties.
Yeah, that's a little tough.
It can be a challenge. So I think right now, like we just want to add doors right now. And so I'm looking more at the cap rate for the bank appraisal because that's what our debt is all based off of. Mm-hmm. And honestly, really, it's becoming even less important because you need the appraisal, but it's only half the equation because they're still going to go off your cash basis. And then it's, it's funny because I'm a lender on the private side, and I'm always trying to sniff out what the true cash basis is of our borrowers. And yet when I'm the borrower,
right,
I'm looking to inflate that,
of course,
that basis so we can try to get the best debt that possible.
That's funny.
So it's, I guess I know how to.
You get it.
I get it. I know how to sniff it out, but that's the game,
Yeah.
Trying to keep as little cash in these things as possible. And so it's the after repair value appraisal, and it's what's the cash flow, and then what's your basis.
This is exactly like something I want to get into. I love this property so much. It probably doesn't exist anymore. I think the ship has sailed, as far as like what you paid and what you got.
I don't know. I think that like you said, there's a new benchmark, right? And so I think that there will be new opportunities. And even like I'm looking at I keep bringing it back to the 90 because it's so fresh in my head right now. But
can we pull that up? I mean, I don't know if you want to reveal that.
I can't pull that one up right now.
I will say this will air in what? Not this Friday, not next Friday, maybe a couple weeks. I mean, is that okay? If not, it's cool, but
I can't do that one just because
that's fine.
It was a foreclosure. It was a foreclosure that we were servicing for another lender. And so he's still shopping out his options, and we're still in the game.
Of course. Yeah. You don't want to screw that deal up because that sounds good, man.
Yeah.
That sounds awesome.
But again, it was just like, even I felt like there was a discrepancy from that deal as far as what the seller and what us as the buyer were willing to pay. And, a significant discrepancy even, but we were able to, I didn't like the number that we were contracting at, but we were able to make it work because of the financing. And actually we getting creative in this market where we said, instead of forcing us to get a bridge loan to then refinance, you have closing costs, holding costs associated with these loans. If you held the note for us and allowed us to do the renovations while you were holding the note at no cost, that could save us $100,000 on the property. And now I can pay you $100,000 more, so.
Seller financing. Yeah. Have you seen a lot of that moving into this new market?
Yeah, absolutely.
Yeah.
I mean, everybody's trying to get savvy and creative,
right?
And I think that's where being able to make giving equity opportunities to the seller, hey, sell me the property and then you can hold a minority equity position if, you believe in this asset and here's our resume and this is what we're going to do with it.
What would that seller have to look like? Would it have to be someone who's owned it for a long period of time that maybe has little to no debt on it?
Most likely.
Right. Because you're not going to find a guy that just bought it 3 years ago to do a deal like that. They're going to want to take their money and go.
Unless he's at distress, like we said, if he's on a 2-year bridge loan and the bridge loan's coming up and his DSCR is not hitting, you can't refinance and he's sitting on 12% interest payments, then he might be a little bit more motivated to get off this thing.
Mm-hmm. You got some stuff like that in the pipeline?
We'll see.
We'll see.
I hope there's, not that I hope there's people in distress, but I do, think this is part of the natural cycle. And if you were making aggressive purchases over the last 1 to 2 years and you didn't have your ducks in a row, we'll be here to take that asset back from you.
In a lot of ways, a lot of those guys see you as a saving grace. Hey, here's a guy that'll come in and get me out of the deal.
Yeah,
I just need to get out. I just need to get out. You kind of hear that a lot.
We are I think we're the right buyer too in a lot of ways. We're capitally backed as a lender. We have a development team. We have a property management company. We have experience doing these types of deals. So when I say that we're going to contract this thing to close, we're a serious buyer. And sellers are in all markets they're looking for that, but even more so in an uncertain market like this. You have a lot of wholesalers that will run around and tie up the contract and then try to resell the contract, and they're not really the ones that are going to close on it. So if you're talking directly to the end buyer who, is a young group that wants to hold the asset for a long time, you're going to have more confidence in that contract.
So when you guys do wholesaling, are you looking at deals from a perspective of, hey, we might even hold this thing. We might be the buyers on this thing.
So the reason, we really tried to set up a vertical integration on the real estate side. So it first started with the lending. And the development partnership made a lot of sense because there's a chance that you're repossessing an asset. And if you repossess it, you need to be able to, a lot of these are, value add investment properties that banks won't finance because there's need of improvement. So if you assume that, God forbid, somebody failed on a project or got hit by a bus and they weren't able to do anything, you need to be able to repossess that asset, number one. Number two, fix it up and get it to its highest and best use. And if the market's down and you can't sell it, your investor's capital's on the deal. So you need to be able to stick a tenant in there and property manage it and create cash flow for your investor. So that's where we felt it was very important to have the lending in tandem with the development and property management.
I think, in my head, that's the biggest pull for you guys. I think that's amazing because I've kind of ran into the issue like that house I wanted to buy in Colbert Isles. Someone else picked it up. I don't have the money to do it right now. I could do it in a few months. So I kind of did need that hard money bridge loan type program. But the problem was a lot of the investors were like, hey man, I can't do this because if something happened to you, like you said, hit by a bus, whatever, I don't want this like unfinished luxury home. Like, I don't care if it's in a great location. I don't care what the market is. Like, I'm not going to finish it. I don't want to be, have this headache on my hands. I think where you guys are awesome is you're like, hey, we'll take it over, finish it up, and we'll make the profit, like whatever. I think that's super enticing right now in this market because a lot of that hard money's dried up on some of those deals.
Yeah.
And it's going to take a guy like you that just likes the deal. And then you're like, okay, check, under it. Like, let's do it.
And not afraid to hold doors. It just kind of matches with our age and our long-term outlook, which it just made sense. So then I guess to come back to your original question, I think when our development company needs to, like I said, there's 3 out of 900 foreclosures. So it's not something that's happening all the time. So you need to keep your development team active. So if it did happen, they're ready to go. So that's why we were flipping a lot of homes and trying to find more multifamilies and just projects for the crews. So it was really challenging over the last 2 years, 2022, 21, very competitive market. And we're buying almost 100% of our deals from wholesalers. So, and we love wholesalers. We originate a lot of loans for wholesalers. We help sell some of their deals to some of our borrowers. And then we were like, why not just step into that space on our own as well, if we have the infrastructure and team set up. So then we started our wholesale branch, and it wasn't super active, like I said. And the real first intent was just to feed ourselves. We just needed our own acquisition vehicle to feed our development.
And how do you have a little team of guys?
Yeah. And honestly, we're at like a 12 team members right now total.
Amazing. Awesome.
Between lending, development, property management, and wholesaling. So we have a lot of guys and girls who wear multiple hats. So, Mike Jones, my development partner, he's also Mike Jones, shout out. Yeah. He's also runs the wholesale company on the day-to-day. We have some younger guys who are fresh out of college and are ripping phones all day, and they'll be looking to do acquisitions, but they also will make a commission on closing a loan as well. So they're out, like if you're out there in the field talking to potential other wholesalers, other borrowers, and other end users, sellers direct, all of those people need hard money too.
Well, such a huge part of your business, I feel like, is on that front end of procuring the property because you have so many options. You guys are buyers, you guys are investors. You could fix and flip, value add, multifamily, like whatever it is.
Sure.
It seems like your scale and growth would just be, hey, let's just try to find as much property as possible. Are you looking to like hire more guys and grow that team?
100%. We're leveraging a lot of technology right now and dialing in our processes. But even over the last 90 days, like I said, it was that shift of we wanted to flip more homes. And then we kind of made that mental shift of if the homes aren't there to flip, let's not get upset about it. Let's just wholesale them instead and keep moving.
I mean, dude, we're 30 years old. So it's like, well, if it's not this cycle, we'll figure it out. If anything, this is a learning period anyway. That's kind of the way I look at it. I'm in this career for the long haul. I'll be in real estate my whole life. So
exactly,
it is what it is. You just gotta grind it out.
100%.
And then you mentioned your wife too. Is your wife involved in the business?
She's not right now.
But she's the one that pushed you to get into it.
Yeah, I mean, she's been with me we've been together for almost 11 years now.
Awesome.
So
congrats, dude. So since you were 19 years old?
Yeah, like 20, yeah.
Holy shit, wow.
Yeah, I remember she was with me on my 21st birthday.
Wow.
So I mean,
it's a long haul.
She was with me at Virginia Tech and kind of watched me bounce around across the country playing soccer and was really patient with me while I get that dream alive. And so, she's been super supportive and, nothing but a good support system for me.
That's awesome.
So I'm blessed there.
My wife works with me too. So
that's awesome.
I get it. Yeah.
Yeah. And now
sometimes it's a little more difficult than not, you know what I mean? It's like having your wife kind of work in your business can lead to, and she's in the other room, so I have to be careful, but it can just lead to problems. You know what I mean? But I think I'd rather have a family type business where, hey, we're all working for the same goal versus like, dad's doing his thing 9 to 5. You don't hear from me all day. And then I come home for dinner. Like, I don't want that type of life. I think real estate's cool because it enables you to have this integrated big life, and you can hang out with your wife and your kids, and it's all good.
100%, dude. And my wife actually did work with me on the Lightning Property Services company.
Okay.
When we started that. And that was a startup type company that was never like super successful either. So a lot of stresses involved.
Did you build that out too? What are you guys doing with that now?
No, I folded that and shut it down when I started buying the multifamilies. Yeah. We just ran the crews within our development company.
It's a great idea. It's tricky. It's
a lot of work.
I was going to say, it's probably a tricky business, but there is a market for it. And I've heard of a couple different services. Sometimes GCs will have a component, like a handyman component. But there's a market for that, man.
I think there will remain a market too, but it's like, you're managing.
The juice isn't worth the squeeze.
It's kind of like one of those. It is. But so we went through our trials, and we really learned a lot about how to work together too while we were doing that business. Yeah. And now it's more of, we have assets, and we're married, so she owns those assets as well. And so now it's like, it's fun to manage our portfolio together and try to grow it. And we're growing our estate plan right now. So it's like a fun journey.
I love that, man. So 20 units up there. And then what else do you have additionally?
We have a couple mobile homes and a condo on South Howard here. And we just bought a duplex as well. So we have a couple, they're all like kind of single family duplex, manufactured homes, condos scattered around. We're at about 40 doors between our group.
Amazing.
Yeah. So we're still trying to grow it more because we've been in transaction mode the last 6 years. We've sold everything until the last 2 years. So it's time to start like adding to our portfolio and holding. That's been a recent shift for us.
Yeah. I'm kind of at that point too. I've flipped like 7, like bigger kind of properties the last 8 years or so. And then I told you I sold that 11 unit portfolio we had. Yeah. And then my next project is a condo downtown. So I'm going to have a little cash. And I think I'm in that mode too, where it's like, hey, I'm not done with the value add flipping or like development. I want to dig into that space one day, but I just think that it's very important to have that cash flow. And if I can just even pick up a couple 4 units, nothing crazy, but a little bit of a portfolio to get some cash in the door every month.
Absolutely.
I think in the future, it enables you to get more comfortable with risk taking. And I think real property development is risky. I mean, if you want to build new construction, you really should have some cash flow coming in to cover your nut. Yeah. Yeah,
that's so true, man. It's like a skill that you continue to develop. It's like your risk tolerance. It's just like you got to practice, That's why even making smaller investments, right? Like just anything you can do to get in the game, just to be making investments, just to develop that skill set.
100%, man. Well, dude, it's 11:15. I know you got to run.
Time flew.
David, you're the man, bro. I thought I learned a shitload. What about you, Tyler? That was amazing, dude.
Appreciate you guys having me.
Absolutely. Really where can people find you if they want lending services or you mentioned a podcast as well? Yeah,
dkclending.com. You can follow us on Instagram and all the social media sites, DKC Lending. And we did just start our own podcast. We don't have the high level setup that we got going on here just yet, but we're working on it. It's called How to Make Money with Hard Money. And so we just shot our second episode last week and trying to bring more content to the world.
Awesome. Well, thanks for coming on, man.
I appreciate you, man. Hopefully we'll do it again soon.
Let's do it. All right. Bye, everybody.
See you guys.